Welcome to another version of Southbank Investment Daily. Well, I saw this chart on Bloomberg earlier on this week. I thought it was particularly interesting. It gives us a graphic representation of why the Bank of England has not been more aggressive in raising interest rates. So we can see here that the number of people that are refixing the 2-year fix on their mortgages runs at approximately 40,000 people a month. There are big spikes in 2021, and that was around the stamp duty holidays. So, because that happened in 2021, as we get into the summer of 23, then there's going to be a spike in the number of people who want to refix their mortgages. Now, some of them may have done so already, they might have preempted, but nonetheless, there are still going to be about 40,000 people a month that are going to be refixing. And that obviously then is going to be a difficult environment for those people. Now, of course, something else that does not get as much play in the media is that there are large numbers of people in the UK who already own their house. So what happens to mortgage rates doesn't affect them at all. But at the margin, where people have been fixing their mortgage over the last few years, then they're going to have a material impact because over the last 2 years, the bond yield has gone from about 50 basis points to 361. And this trend is still upwards. So there's the potential that by the time we get around to May, June, then there will actually be a higher fix. So that's the primary reason why the Bank of England is raising rates, but not raising rates nearly as aggressively as it might do. When you've got inflation at 10% and the base rate at less than half of that, well, then there's a big window over which, or a big chasm really, over which they need to get in order to disincentivize demand in the economy. And of course, what we have right now in the UK is people agitating for higher wages. And you have the junior doctors on strike, and now you've got uh, the public employees saying that the pay offer they were made is insulting. So we're still in an environment where interest rates are below inflation. And what seems to be coming out of the US is that the Federal Reserve, or at least the bond market, is willing to believe that the Federal Reserve might be reasonably comfortable with that phenomenon. Now, if we look first at the UK stock market, well, the FTSE 250 has had a very negative period between 21 and 22, but it is rebounding. And that's a higher reaction low. So the initial rebound from the low in the third quarter of last year broke the downtrend. And then we've had some consolidation, and now it's rebounding again. So this is the beginning of bottoming activity. So that is quite positive for the UK market. And the pound continues to steady. Now, I think it's important to look at lots of back history, because when we look at a decade of history, well, then we're presented with this range that took place between about 120 and 140 and lasted from 2016 to 2022. And then we had the big decline in 2022 and then a big snapback. Now, that's a failed downside break, and it has now pushed back above the 120 area. Now, there is clearly the potential then that it could rally back up towards 140 over the course of the next couple of years. And if that's to be the case, then it will sustain the break above 125 in the next couple of weeks. So, from the perspective of a foreign investor, then let's go back and look at what the FTSE 250 looks like if we redenominate it into dollars. So this is, I think, one of the most important points, that when you look at it in dollars, the market has mostly been ranging since 2013, and now it's coming up from the lower side of that range. Big international investors, they like to have the capital market, the central bank, the currency, and the yield on their side? Well, because the dollar was so strong for so long, then it was a it was the most attractive market for foreign investors, and lots of money flowed into the US market. But now that the dollar index is trending downwards, then that creates a great deal of competition for those international flows. And the UK is a big developed market, and with a reasonably valued stock market, an appreciating currency, and companies that have got attractive yields, it's going to become a more attractive destination for international flows. But of course, if the uh, if the dollar is coming down, then that is also positive for gold. And gold prices are right in the region of the upper side of their range. Now they've raced to get here, so we could easily see some consolidation, and that does appear to be underway at present. But if the dollar continues lower, gold will reflect that by continuing to march higher. And Bitcoin has been resurgent recently. So it is now back above the 30,000 level. Now, the primary reason for that is because Twitter has been turned into the X company. Elon Musk wants to create I guess, a super app, and what he intends is that people will be able to buy crypto via their Twitter accounts. Well, there's a lot of people follow him, and particularly his musings on various cryptos, and now they'll be able to activate their interest via Twitter. So that's a big pool of new liquidity coming into the market, and it's helping to support the price. This week we also had a major fork in Ethereum, and Ethereum didn't really do much ahead of the fork, but then as soon as the fork ended, it has popped on the upside. So it's not just Bitcoin here. We're seeing more of the smaller tokens also starting to move, but it's all happening against a background of a weaker dollar, and then the promise of more liquidity. The main thing that's happening in the market right now is investors are betting that we are approaching the end of the USA's hiking cycle. That's why the dollar is starting to roll over. Now, the 3-month yield is up to almost 5%. So it's not quite yet pricing in another 25 basis point cut, and that's quite similar to what we've seen before every one of the other interest rate hikes over the last year. The 3-month yield will only begin to price in an interest rate hike only about a week before it actually happens. And that tells you how much demand for short-term paper there is in the market, because there is so much money that has to be invested in bonds, does not want to own longer dated paper. So they're all moving it into very short-term paper, like 3-month bits of debt. And then because of that demand, it's suppressing the yield. And the only times when that yield is rising is when right before the actual interest rate hike occurs. The next Fed meeting will be in the next 3 weeks, and it is very likely they're going to raise rates one more time. But the bond market appears to be betting now that that will be the last time they hike. Now, if everything looks rather rosy, the note of caution that I would make is that the yield curve spread and that is the spread between the 10-year and the 3-month, is still close to a record low. And as long as it is making new lows, then we can have a benign environment on the stock market. But we should also pay attention to the fact that when the yield curve spread turns around and starts trending higher, that is usually consistent with a deep decline in the stock market. We've seen examples of that in the early 2000s, in 2006 and 7, and then also in 2019 and 2020. So now that it is at lows that haven't been seen since the early 1980s, well, we have to bear in mind that back then there was a deep recession in response to the massive tightening that followed the inflation of the late 1970s. And the kind of tightening that we've had over the last year, it might not look like the same volume or the same jump in rates that we had in the late 1970s, but it was coming off an exceptionally low base where a lot of people were very levered on the debt front. And that is continuing to weigh on banks. So the S&P 500 Banks Index, it's steadying over the last 3 weeks, but it's not really rallying. And when banks underperform like this, well, that's generally not good news, and particularly for the US economy. Of course, if the US economy does slow down, that's going to put even more downward pressure on the dollar. It's going to make international markets even more attractive. And then it will also boost demand for alternatives to the dollar. And gold, Bitcoin are two of those. But of course, then we also have oil. And oil prices remain quite steady and holding this pop higher that we had last week following the announcement by OPEC Plus that they're going to shelve 1 million barrels of production. And then there's this big argument about whether it's going to be barrels or shovels that drive the economy. Well, copper prices remain quite steady and have now bounced from the region of the 200-day moving average. And that is that's an upward dynamic that certainly helps to confirm near-term support. What it suggests is that the energy transition, regardless of whether it makes sense or not, is something that money will get poured into. And that means significantly more demand for copper. And I think with that, I'll leave you for today, and I'll wish all the best to all of you.